We are off to the races. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Meta seizes its AI moment as Microsoft joins the $4 trillion club. Apple and Amazon take the spotlight tonight. President Trump unleashed a flurry of last-minute trade moves ahead of his tariff deadline, including surprises on India and copper. Plus, the president has renewed his feud with Fed Chair Jay Powell as the deluge of data continues. Such amazing alliteration.
There we go. And there's a lot to get into, as Matt just walked us through, but I think we have to start with earnings, and we have to start with some of these big tech names. Meta soaring as it takes advantage of advertising revenue to boost its AI spending, which is now expected to top $100 billion in 2026. Microsoft is behind me, though. Here we go. Here's Meta, up about 11% right now.
They're different stocks, even if...
They both start with M.
That's true. I was going to point that out as well. Microsoft is the one that's going to hit $4 trillion today at the open, thanks to a strong cloud growth and AI expectations. The company says 800 million people interact with its AI features in some way, shape, or form, which seems like a lot. Seems like a lot of people.
Yeah, absolutely. Let's get deeper into these tech earnings and welcome in a roundtable now of Bloomberg Tech co-host Ed Ludlow, as well as Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. And Ed, I'll start with you. And honestly, it's hard to know which of these companies to start with. So let's start with Meta, because we were talking about that massive spend. It depends, of course, on the advertising revenue continuing to sort of knock the cover off the ball, to borrow a phrase from Matt Miller. It seems like for right now, that dynamic is working well.
Yeah, the simple story or the reaction from analysts is that what we saw in growth in the core ad business, as well as ad pricing, justifies ongoing investment into AI. So the headline was that capital expenditures in the current fiscal year, they narrowed the range, right? $66 billion to $72 billion. But what was most unusual, like it was a big surprise, was in the CFO Outlook commentary, but also on the call, they gave us a lot of detail about what happens next year in 2026. And basically, what Susan Lee, the CFO, said was that capital expenditures will continue to grow and grow at a rate that's above this year. It's a really long-term commitment from Meta to continue investing in infrastructure. Data centers the main cost from a CapEx perspective, but increasingly talent hiring is a part of that. And on the OpEx side, they were also kind of honest that, like, look, our leases and our energy costs are going to go up proportionately as well.
So let me ask Mandeep, if they have the free cash flow, do they have the actual cash on hand? How do they finance this?
Well, so you're right. Up until now, they were able to use the free cash flow that they generate from their operations to fund their CapEx. Now, when we are talking about next year, 100 billion plus in CapEx, clearly that's not sufficient, and they're probably going to partner. And look, when you are growing 22%, I mean, the street is going to give them a lot of benefit of doubt that they'll be able to monetize, and the top line will continue to benefit from AI spend. But right now, we don't have enough proof points because their large language model still trails the likes of OpenAI and ChatGPT. So a lot of this AI top line growth is really maybe taking share from the likes of TikTok. We don't exactly know for sure that AI is getting monetized the same way it shows up for Microsoft. In Azure, AI is 21% growth contribution, and that's the cloud infrastructure that they have a backlog of over 300 billion. So the visibility for Microsoft when it comes to AI spend is far more than the likes of Meta, where, again, they are benefiting, but probably not the same way as Microsoft is.
And you mentioned Azure, so maybe we should talk a little bit more deeply about that, because this was the first time that they broke out Azure revenue, correct? And how does that set us up as we get into some of their rivals' figures coming tonight?
I mean, look, Azure is an $86 billion business growing at almost 40%. So when you compare that to an Amazon, which is $115 billion run rate, growing at close to 18, 19%, I think there is clearly a share shift going on driven by AI. And so with Amazon, you want to see that sequential increase in growth. So Azure went from 35% to 39%. Because they said it will be supply constrained, chances are they're probably going to top 40% next quarter. You want to see that same sort of sequential improvement in Amazon AWS growth. It has to grow from 18% to probably over 20%. If they don't do that tonight, probably you can infer that Amazon is losing share, because we saw that from Google. They went from 28% to 32%. So that sequential growth is very important for Amazon AWS.
Ed, Microsoft says 100 million people use its Copilot, and that 800 million use its AI products in some way. Are they just making these numbers up? That doesn't sound real.
No, I'm sure they're not making them up. But Mandeep's earlier comparison was really interesting. Do we have better data for Microsoft or Meta on how AI is being used by the user base or core customer? So Copilot is interesting because saying that more than 100 million people a month use it for Copilot AI stacks Microsoft up against ChatGPT, even on the enterprise level. You know, it's a more directly comparable data point. Compare and contrast with Meta. What we learned about Meta was the core ad business has been strong. There's been pricing strength because of AI investment, and even Chinese advertisers pulling back, they still did well. But this big vision that Mark Zuckerberg has for AI, we don't have the same Copilot data point. What we did learn in the quarter gone is that they actually saw sales of the Quest AR/VR headsets drop, while sales of the smart glasses, which you guys know I'm aware of, right? Not today, they went up.
Mandeep too.
And that's the form factor that Zuckerberg's really pinning Meta's AI future on. What is the AI future for Meta? It's one where you buy their smart glasses as hardware, augmented reality at a later date. You use their models through that as a generative AI tool, but they're targeting not productivity gains or knowledge workers like Microsoft does. Zuckerberg even threw shade at that. They're targeting the creator economy and everyday people. We don't have any data around whether that's paying off yet or not.
All right, you guys in your glasses. Before we let you guys run, Mandeep, I do want to talk about what we're expecting after the bell tonight, because we knew that Microsoft, Meta, that these were expected to be up arrow stories. That's what we're seeing in the pre-market today. When we're talking about Apple, Amazon, more of a mixed picture that's expected. So as you dial in tonight, what do you want to hear? Which of these stories are you more excited to get some clarity around?
I mean, in the case of Apple, everyone wants to know their AI play, and clearly there is a big tariff impact now with India getting tariffs. So in the case of Apple, the tariff impact and AI, and in case of Amazon, you want to see that sequential AWS growth. If they don't show that, you're not going to see a similar stock reaction.
All right, we're going to be watching for that. Mandeep, thanks so much for joining us. Mandeep Singh there of Bloomberg Intelligence. And Bloomberg Tech co-host Ed Ludlow, you can catch his program kicking off at 11 a.m. New York time, 8 a.m. Am I doing that right? In San Francisco. Yes, of course, Pacific time. President Trump resumed his seriously harsh criticism of Jerome Powell after the Fed declined to cut rates. In a social media post, the president wrote, "Powell is too late and actually too angry, too stupid and too political to have the job of Fed chair." Meanwhile, the market is holding gains following the latest inflation data, which showed an increase at the fastest pace this year. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now at the desk. Mike, I thought Powell was a very good man. Didn't Trump just say Powell was a very good man?
As recently as last week?
Yeah.
Yeah, well, this is all like being called ugly by a frog, as the saying goes. I don't think Jay Powell is too worried about it at this point. You want to make some money, though. Tell the folks at Meta or Microsoft to invent glasses that will enable you to see into the future. That would be useful, because
ball, perhaps.
The Fed is trying to figure out what's going to happen. Yesterday, Jay Powell made the case that the economy is still in good shape, even though they are expecting inflation to rise as tariffs get into the economy. And the data today back up that argument. You look at the PCE headline and core numbers. They were revised up for April, revised up for May, and they're higher in June, 2.6% and 2.8% for year-over-year numbers in terms of the headline and core, and that is certainly not something you want to see if you're thinking about cutting interest rates. Spending ticks up again, up 0.3% after a couple of months of flatlining. Not a huge amount, but Americans are out there still spending some money, in part because they're making more. Incomes were up 0.3%. Now, here's an interesting stat in the PCE report for income. Wages and salaries only went up 0.1%, but in the employment cost index, which is a quarterly number, also came out today, wages and salaries were up a full 1%. So somewhere in there is the truth, and it does appear that Americans still have the money to spend. Now, let's take a look at the labor side of the argument for the Fed. Jobless claims certainly suggest that Jay Powell's right about the strength of the labor market at the moment. We're not seeing any real move towards laying workers off. Here's the ECI, as I mentioned, up 0.9%, same as last month, but we're not seeing a huge inflation impact on that side of it, and wages were up. Now, here's the chart you don't want to see if you're the Fed. You can see in the last couple of months, we're moving up again with PCE inflation towards 3%. If you get to September, and that's what you're looking at, it's going to be very hard to make a case for rate cuts. So right now, the data are saying the majority on the Fed and Powell are correct in their assessment, but we've got a couple more months to go before they meet again.
Well, we'll get another piece of the puzzle tomorrow morning at 8:30 with the unemployment rate. That's expected to tick up slightly. We're going to get into all those details with you tomorrow. That is Bloomberg's Michael McKee. Now, coming up,
more tariff surprises, countries rushing to strike a deal, and copper traders get a huge shock the day before the deadline. We'll discuss that all next. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Rocos Capital Management is asking investors to agree to an increase in their fixed management fees to 2.75% over the next 3 years. But wait, there's more. The performance fee will also increase to 25% over the same period. That decision is driven reportedly by the firm's efforts to invest in talent as well as in research and technology. And as a good friend once told me, these yachts are expensive. The global copper market is reeling after President Trump imposed 50% tariffs on copper imports, but exempted refined metal, so the final product. The decision to exempt refined copper is upending the global trade of the metal, which plays a crucial role in the world economy. You can see that we have big drops today, but yesterday they were way bigger. We need this stuff, obviously, for electrical wiring. Ford Motor is falling in the pre-market. They use a lot of copper. After announcing they would take a $2 billion tariff hit, the CEO, Jim Farley, joined me yesterday to talk about the fallout.
We think it's $5,000 on, like, say, a RAV4 versus a Kentucky-built Escape, and maybe as much as $10,000 on a Japanese-built 4Runner or a Subaru versus, you know, a Bronco built here in Michigan. So it's really meaningful.
Now, Ford recorded that tariff hit before a spate of new trade surprises unleashed by the president in the 11th hour before his August 1st deadline tomorrow. For more, let's welcome in Bloomberg's Washington correspondent Tyler Kendall, joining us live from D.C. So August 1st is tomorrow. What is the logic here? What are people telling you about why perhaps we're seeing this flurry of trade surprises just as we drumbeat to that deadline?
Right, exactly, Katie. It's clear that the administration says that it wants to hold firm on that August 1st deadline, and we've sort of seen this hurry to get some sort of announcement out there, even if we have to wait on the more formal details down the line. And even as we get some of these announcements, like South Korea, like President Trump's threat now against India when it comes to 25% tariffs and then an additional penalty over their imports of Russian energy supplies, there are still a lot of nations that were waiting to see if we would get any movement. I'd point you to the fact that President Trump is expected to hold a call with Mexico's President Sheinbaum later on this morning. Our reporting indicates, according to people familiar, that negotiations have reached the point where now the decisions have to be made on the leader level. So perhaps that could be taken as a sign of optimism. But we do know that the White House wants a broad array of concessions, particularly when it comes to Mexico, whether that be fentanyl or addressing the goods deficit, for example. I would also point out that we are expecting a few other agreements to come later today, particularly when it comes to Thailand and Cambodia. We heard the U.S. Commerce Secretary yesterday say as much, that they have reached an agreement. Matt and Katie, they are facing a particularly high tariff for that region, 36%, though it does seem like it's going to trend lower.
Man, if Mexico gets 15% too, all auto production is going to move out of the United States. What does the administration say to the concern that if they're nickel and diming U.S. producers to the point where vehicles cost $5,000 to $10,000 more to produce here than they do in Japan or Korea, it's running counter to their goals of bringing production back?
Right. And Matt, they've been really defensive on that point. They say that they want to bring the investment here, and they want to just start making sure that there's that cushion to lead to production down the road. They really haven't addressed those concerns in perhaps a more meaningful way other than that. I will point out, though, particularly when it does come to autos, we haven't really seen much of a movement in terms of a Canada deal. We did hear from Canadian Prime Minister Mark Carney yesterday, who said that he doesn't seem, he's sort of lowering expectations. He doesn't think that they're going to be able to get over the finish line in time for August 1st. Of course, also at play here with our North American trading partners is USMCA compliant. And while we do see a bulk of goods that are USMCA compliant, ultimately there's still a lot that's left on the table. Just from Mexico's statistics, I pulled the data this morning, 83% of the goods that come over the southern border are USMCA compliant, but that still leaves about $80 billion worth of imports that are subject to a higher tariff.
All right, Tyler, certainly a fluid situation. Really appreciate your reporting. That is Tyler Kendall joining us from Washington. Now, some other movers on our radar as we count down to that opening bell. eBay gaining as sales growth tops estimates, and Americans continue to shop on the platform. Shares up a whopping 13% pre-market.
Yeah, big move there. Also, Norwegian Cruse says demand rallied in recent months, allowing it to confirm its guidance. That's good for a 11% gain in the shares pre-market. And we're going to hear from the CEO of Norwegian later in this program. Harry Sommer joins us.
Looking forward to that conversation. Let's quickly talk about Shake Shack having a totally different morning, slumping in a big way after the burger chain forecast revenue that fell below expectations, pointing to inflation and those cautious diners. They're spending all their dollars on eBay. They don't have money left over for Shake Shack.
Well, the Shake Shack burgers are very expensive, and I actually need to do the math. Maybe if I cut out my Shake Shack spend, I could afford Zepbound.
Gosh. Which is partly one of the things that we're going to talk about next, GLP-1s. Coming up, a ton of health earnings this morning. We'll dive into that sector next. This is Open Interest. CVS surging this morning after raising guidance for the full year, with the Aetna health insurance arm and its pharmacy unit both outperforming expectations. Bloomberg health reporter Ike Swetlitz joins us now. Ike, you and I spoke to David Joyner about these results, and a big portion of the conversation was about what exactly is CVS doing when it comes to predicting those insurance costs that have tripped up plenty of its rivals.
So maybe a year or two ago, CVS saw similar problems that other insurers are seeing now in the market. They repriced their plans, changed some of the benefits, and so are better positioned now. Other insurers, didn't make those changes at that time, and so are feeling the effects now instead.
What's the result of the huge story around GLP-1s? Because for some of the GLP-1 producers, it turns out to be not great. How is it for CVS?
Well, so one of the parts of CVS's business, Caremark, is a pharmacy benefits manager, which helps employers and other plan sponsors manage their drug costs. And one of the things that they've been doing, starting recently, they've decided to sort of prefer, push patients more toward one of the drugs, Novo Nordisk Wegovy over Eli Lilly's Zepbound, and they are doing that, in order to get a better price on Wegovy. They aim to save those employers and other plan sponsors money. They estimate about 10 to 15% of the obesity medicine costs. We'll see, over the next few months as data comes in how that's playing out.
Yeah, and remember, Matt, in May, they dropped Eli Lilly's Zepbound as the preferred drug. That was certainly a win for Novo.
Tirzepatide.
Yeah, there.
Should I go to row.com to get that instead of CVS?
I, as a journalist, am not prepared to give you an answer there. But Ike, before we let you go, let's quickly talk about risks potentially to this upgraded outlook that CVS gave. It was interesting. It seems like vaccines, whether or not people actually go out and get their COVID boosters, could be a potential wrinkle here.
Yeah, so that was something that the CEO mentioned. It was also mentioned in regulatory filings a little bit earlier this year. There have been a number of government changes to CDC recommendations, also just changes in attitude from government health officials. Vaccines are profitable for large chain pharmacies, and so it's a question of what's going to happen sort of in the second half of the year here.
Ike, thanks very much for your reporting. Great story. We're going to continue to follow this because, frankly, everyone cares about CVS.
Yes.
Right? Is that just in New York or?
I do worry that might be our own bias, but definitely we interact with CVS a lot. We were talking about COVID vaccines. Let's quickly talk about Moderna. Moderna, the news out that it's cutting about 10% of its workforce to reduce spending as COVID vaccine sales decline, potentially also an issue for CVS in the second half. Yeah, we see Bristol Myers down, as well as Eli Lilly. We'll talk about all these companies at the open and beyond. Just 3 minutes to go until we do that. This is Bloomberg. We are moments away from the start of trading, and we're looking at potentially a new record, definitely another $4 trillion company in Microsoft. This is Open Interest. I'm Matt Miller. We're seeing futures rally pretty hard, 0.8% on the S&P futures, more than 1% on NASDAQ futures. Small caps are moving down. You hear and see the opening bell at the New York Stock Exchange. Figma out with the biggest IPO this year, and they are pumped. It looks like fun. It looks like fun down there. At the NASDAQ market site, you've got Intuitive Machines. The ticker is Lunar, L-U-N-R, and it's a pretty cool business, but the stock has been a dog, down 36% so far year to date. Speaking of stocks, you're looking at one going the other way. Katie Greifeld, what is it? Yeah, we all can't have performance like Microsoft. You take a look at what it's doing this morning, becoming the second $4 trillion company thanks to huge growth in its cloud business. Its CEO says that some 800 million people interact with the AI features in its ecosystem. I know Matt Miller has some suspicions about this. Shares currently up about 7% right now. I believe it was even higher pre-market. I do wonder, Matt, if we could see a Starbucks situation where it opened so much higher and then those gains faded. But at least for right now, people are excited about Microsoft and buying shares at the open.
Buy the rumor, sell the news happens. Katie, do you use Copilots at all, Microsoft Copilots?
No, I'm not the best person to ask.
Because apparently 100 million people do. Do you use Microsoft AI products in any way?
I'm very AI resistant.
Apparently
so maybe
800 million people do.
Apparently.
I don't. So I don't know where those numbers are coming from.
You are representative of every person there ever was, so who knows?
Meta, well, the two of us together. Meta's digital ad growth is still outpacing YouTube and TikTok, helping fuel AI spending, which Bloomberg Intelligence says will top $100 billion in 2026. That's for this one company. They're going to spend over $100 billion on AI next year. They're spending over $70 billion on AI this year, and yet the stock is up. I guess, they did better than expected. They had a great outlook, an 11% gain for Meta Platforms. It's pretty fascinating to watch. Moneta Chief Global Market Strategist Aoifinn Devitt joins us now to talk about this big run-up in the AI bet. Just when you thought it couldn't go any further, Aoifinn, it continues to rise and looks like it's going to push us to new highs. What's your take?
Exactly. It did seem, I was surprised at that Meta number 2. One would have to think that a lot of this was already priced in, but clearly there was a lot of money sitting on the sidelines keen to get on this really arms race that we're seeing around AI, data centers, and just spending. So quite surprising, probably coming from the sidelines of money market funds, but it just really remains to see what the rest of the year has to hold in terms of this momentum.
Yeah, absolutely. That is the big question there. This is a very busy week, to put it mildly. Of course, we got the Fed decision yesterday. We had the press conference. We have a wave of economic data, and we have all of these earnings. For the trajectory of the rest of the year, Aoifinn, what is really going to be the catalyst? I know the answer is something along the lines of all of them, but what do you think is really the driving force of this market through the end of 2025?
I think when it gets down to the detail, the devil will be in the detail of the execution and how some of these trade deals actually look on the ground. There was a lot of fanfare around the EU trade deal, this commitment to invest in the US, really unprecedented. It wasn't quite clear what the EU got from that trade deal, if anything. Certainly seemed like a net negative for them. But now it will remain to be seen as to how that will actually be enforced. We also have some deadlines being set by President Trump around the geopolitics of the whole region, particularly in Ukraine, Russia, and that will have an impact on the supply of fuel, and we'll see how Europe fares. Europe won't be in any position to fulfill its conditions if it is continuing to be really facing these headwinds. So it's going to be the devil in the detail. We have this strong growth. Does that feel like that on the ground? We're seeing pictures of empty Las Vegas. We're hearing about the consumer feeling the pain. We saw Carvana up today because we know that used cars are in higher demand, probably reflecting a lack of interest in buying new cars. So we do have this kind of coming apart at the seams for the lower end consumer. So it remains to be seen just how this euphoria is translated into the rest of the year.
I mean, I got to say, Aoifinn, it seems like Europe got away pretty good with just 15% flat tariffs on the cars that they sell into this market. Whereas U.S. producers like Ford, they had to pay 50% on steel, 50% on aluminum, 25% on foreign parts, up to 80% stacked tariffs on Chinese stuff. And when you get done adding that bill up, they're paying $5,000 to $10,000 more per car than direct rivals being looking at production in Japan or in Germany. Is that a concern to you that the administration is shooting itself in the foot with this tariff policy?
Well, that's certainly been the economic dogma that tariffs are not good for around inflation. And certainly the Fed seems to believe that. It has not been in any way kowtowed by pressure. We know that today, even though there were 2 dissenters. So they're quite clearly concerned about the effect. We do know that the transmission effect of tariffs is going to be delayed. And we're all focused today, myopically it seems, on the tech earnings. And we've almost forgotten about the old economy earnings that were getting the headlines last week when we heard about just how much these already razor-thin margins in the old economy stocks, like the auto manufacturers, are being erased by tariffs. And this is really where the uncertainty remains. There is less uncertainty, I'd say, in the AI momentum. We all know what direction that is heading. We all know the commitments to expenditure that have been made and the deep pockets that can support that. What we don't know is where the other old economy companies, how they're likely to fare, and a lot of uncertainty still prevails there.
Absolutely. A good reminder on that persistent dichotomy there exists when it comes to the old economy and the new economy. But to that point, Aoifinn, you asked the question in the notes that you sent over to our producers. Should we look at big tech stocks in the U.S. as a law entirely onto themselves, such as a fifth estate? I'll ask you that same question. Are they a fifth estate at this point?
It does seem that way. They certainly seem to be immune from trade, from geopolitics, from many of the other factors around consumer demand. They have built giant moats around themselves. They were basically dominating the US stock market. Investors seem to like that. They've seen that state of affairs prevail for 18 months. They haven't been in any way perturbed, it seems, by the fact that other smaller mid-cap stocks, as well as older economy or more basic stocks, have not participated. So I would say equally that the seat at the table that these tech leaders are getting now is unprecedented. We've just seen them really start to move the needle and influence policy in a very big way. We saw that with the recent AI bill. They are going to be driving their own vertical integration of supply chains around data centers, etc. So it really seems that they are somewhat untouchable at this point in regards policy that doesn't affect them.
All right, Aoifinn, that's a good place to leave it. Great to get some time with you. That is Moneta Chief Global Market Strategist, Aoifinn Devitt. Meanwhile, let's get a check on this market. We're about 7 minutes into the session, and the numbers look pretty good. You're up 0.7% on the S&P 500. But if you wanted to get a little bit worried here, this is a pretty narrow rally. You have about 200 names in the green, 300 in the red, trading places a little bit there. It's all the names that you would want to see leading the way higher: Microsoft, Meta, Nvidia, Amazon. The list goes on. But you can see that Microsoft gains, they're already starting to fade. The company's still up 5.5%. Certainly nothing to sneeze at, but still not where we were pre-market. On the other side, you do have Meta extending their gains from the pre-market, currently up about 12%, and Amazon getting a bit of a bid before it takes the stage tonight. Take a look at the downside quickly. You can see that Alphabet dragging us down. You also have Lam Research and Applied Materials on the back foot as well. Let's take a look at what this looks like at the sector level. This is interesting too. You have communications up at the top, up 3%. That's just Meta really flexing its muscles there. Big tech also having a good day, as we know. You go down to the bottom. It's pretty much an even split right now, Matt Miller, but you can see that real estate, consumer staples, and healthcare are your laggards of the day, even though CVS put up a really impressive beat and raise quarter last night, or this morning rather.
We are focused on here on set and in the control room Microsoft's GIP graph, because one of our producers, Assad in London, wants to make a bet with you that Microsoft stays above $4 trillion through the closing bell at 4 p.m. The stock is trending down a little bit. Right now it's worth $4.024 billion. You going to make that bet?
It looks a little bit vulnerable. I'll take the other side.
All right, very good. We'll continue to track that to see if Assad wins or Katie does. Coming up, Apple and Amazon on deck after blowout results from the M's, the A's after the bell today. And we'll talk about what to expect next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, United Health getting cut to a sell over at Baird. The firm sees a more challenging road ahead for the company after it reported results that fell way below expectations. Shares down another 3% this morning. Next up, CoreWeave getting upgraded to a buy over at Citi. The firm expects that AI demand will continue into next year, and Citi says we come away with a stronger view on the demand picture as highlighted by Microsoft. And speaking of Microsoft, Wall Street weighing in on its stellar quarter. KeyBank raising its rating to a buy, whereas you have JP Morgan, Barclays, and TD Cowen all raising their price targets. The software giant just moments ago hitting that $4 trillion in market cap, Matt, but there is some debate as to whether that will hold through the close today.
Right, we see this is a 2-day chart, so obviously a massive jump overnight after those earnings. The question is, does it keep at $4 trillion? We saw Starbucks, as you point out, go up and down yesterday, and a lot of times investors like to take profits after these big milestones. Meta is also rallying after delivering a strong revenue outlook. We are waiting now for Amazon earnings after the bell. Joining us with more is Youssef Squali, senior analyst at Truist Securities. He has a buy rating on Meta with an $880 price target and a buy rating on Amazon with a $250 price target. Youssef, great to have you on the program. Before we get to Amazon, what's your take on Meta's spending? Because it seems to me that they're running out of money.
They're not running out of money. And I think to the extent that they continue to deliver the goods in terms of accelerating top line growth, which is what they delivered last night. Last night, they put up a 22% growth versus like 16% the quarter before, to the extent that they keep delivering the goods on the margin side and on the EPS. They delivered like a 43% operating margin, up from like 41% the quarter before. I think they have earned the right to continue to invest and continue to chase this AGI or SGI, as Mark Zuckerberg likes to call it, right? So, I think the $100 billion or the implied $100 billion CapEx number for next year is dizzying. But when you look at the underlying, kind of drivers of the business and how AI has so far really improved the economics, it has improved the advertiser conversion, it has improved the user engagement. And remember that like 3.4 billion users already and growing. Again, I go back and say they have earned the right to continue to invest.
Yeah, and I think that's a really important point, because I feel like a broken record at this point, but I keep bringing up the year of efficiency that followed that massive cash burn on the metaverse. And right now you have investors really cheering along this AI spending. Of course, there's a bit of an arms race going on when it comes to the Magnificent Seven and the CapEx spend. But Youssef, how much confidence do you have in this management team to actually spend that money in a way that delivers results, some ROI here?
Well, so the answer to that question is not very clear, and honestly won't be satisfactory, because we don't have the KPIs to be able to say they've spent, they're spending $70 billion this year. What are they really getting for it from an ROI perspective? And that's because this is a company, even going back to its IPO in 2012, has really been investing with an eye towards the 5 to 10 year plus investment horizon. That said, the breadcrumbs that we have is what I mentioned earlier. Today, they're using AI to drive their core business, right? And to the extent that they're able to accelerate the top line growth, to the extent they are able to increase the user engagement, increase the advertiser ROI while generating higher margin, right? That's really all you can ask for today. 5 years from now, 10 years from now, I think it's going to be a totally different environment. We're going into an environment where maybe the smartphone won't be the primary way people are communicating, et cetera. Maybe it'll be smart glasses. Those are the type of investments the company is investing in. Today, they're losing their shirt on them, right? Doesn't mean that 5 or 10 years from now, they won't. But going back to the IPO, seeing how they've been able to execute against what they've promised, I think it's a stellar management team.
I hope I don't live to see a future where people communicate via smart glasses, Youssef. Smartphones, bad enough. I want to ask about Amazon, because President Trump surprised a lot of people with some tariff changes yesterday. And one of the things he's going to do away with is the exemption on goods under $800. When I think of companies that sell Chinese stuff that costs less than $800, I think of Amazon. How come investors don't care?
You're not wrong. You're not wrong. Keep in mind a couple of things, though. One, over half of all the goods that are sold on Amazon, they're actually sold by third party, right? And Amazon takes a cut. They take a 35% margin. So in a way, as those costs are passed on to consumers, ASPs go up, average selling price goes up, and so Amazon actually gets a higher cut of that. Of the other piece that Amazon sources itself, we think Amazon, this is a relative game, right? We think Amazon has the scale, they have the logistics, they have the brand, they have the relationships to actually, pound or force those manufacturers back in China to give them the best deals they can, or they will give to any of their partners. So again, maybe net Amazon loses a bit of growth from the de minimis exemption going away, but because this is a relative game, Amazon still comes out a net winner, in my view.
All right, looking forward to maybe getting some clarity at the bell today on Amazon. Great to preview those results with you, Youssef. That is Youssef Squali of Truist. Also reporting after the bell today is Apple. And here with a preview is Krish Sankar. He is senior research analyst over at TD Cowen. He has a buy rating on Apple with a $275 price target. It's been hard to be a buy on Apple this year, Krish. And you think about why. The big reasons are, of course, trade uncertainty. How are tariffs impacting Apple? And that overhanging narrative that Apple has really fallen behind on AI. Do you expect any dispelment of those two narratives after the bell this evening?
Yeah, hi. Thanks for having me, Katie. I think you kind of characterized it very well. This has not been a great year for Apple, at least in terms of headline news. Number one behind in AI, tariffs, lawsuits, Google, TAC, etc. I don't think you're going to get any of the resolution today, to be honest. AI still is a longer-term thing. The management usually doesn't comment on ongoing litigation, so you're not going to hear anything about, any of the Google tax stuff. Maybe they might quantify some short-term impact from a tariff standpoint. But other than that, I don't think you're going to get a resolution from AI and any of the overhang the stock has been having today.
In terms of the spend, when does it get to be too much, Krish? I mean, I could ask that question for any of these companies, but Apple seems to be the one that needs it the most.
Yeah, you're not going to hear like Meta, Microsoft's kind of numbers, right, in terms of spend. I think last year CapEx is about 10 billion, give or take. I think they do obviously have like more of a cloud strategy where they go through other third-party data centers. I think what the investors really want to see is some kind of, I would say, a coherent AI strategy from Apple's standpoint. People got excited last year with Siri, and that didn't really go much further. I think what you need is something more concise. I would also say that, if you look at the smartphone, I do believe that they need to have better hardware specs in order to do more inference on the edge. I believe to have a better, more seamless cloud strategy in case the smartphone has to integrate with the cloud to do inferencing. And then third, I think more importantly, have some sort of like Gen AI software development kits so you can actually transact with third-party apps. Clearly, the apps aren't there much today, but I think it might come out in the future. But I think these are a few of the things that Apple needs to do in order to show that, you're doing something on AI. But you're not going to get any answer today. But I do think that they still have probably a year and a half or so before people really start seriously worrying about them.
And Krish, we have less than a minute left here, but I think back to Texas Instruments, their results, how they were unsure whether the demand that they saw in the previous quarter was a pull forward ahead of tariffs. Could we see something similar with these Apple results?
Yeah, I think we've been hearing from the supply chain there was some probably pull forward, especially on smartphones. It's hard to quantify it. Keep in mind, Apple probably run rates around give or take 50 million units on a quarterly basis around this time. There might probably be a handful, maybe a couple of million that got pulled in because of tariffs. They're not going to tell you the exact amount, but I do believe there was some kind of pull-in.
All right, Krish, great to preview these Apple results with you. That is Krish Sankar of TD Cowen. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks the day after Microsoft and Meta released earnings that impressed. You see S&P 500 6413, so holding firmly above the 6,400 level, an all-new high. We've made an intraday high, and if we stay here, a closing high. NASDAQ up 0.8% as well. Actually, I don't look very often at the dollar. Wait, check out, Ryan, the dollar here. I mean, it's been on a run. It's been on a little bit of a streak. So that's interesting as the 10-year yield drops down to 4.35. Apple right now, little changed. Amazon up 1.5% there after the bell. CVS impressing with earnings we talked about. We'll talk about it more, up 5.7%. Norwegian Cruise Lines up almost 14%. We're going to talk to the CEO in the next hour. Katie?
All right, looking forward to that conversation. I will point out that Microsoft is still up 5%, which is not bad, but it was as high as 8%. So fascinated to see if those gains
winning
hold.
The bet.
This is Open Interest.
We are 30 minutes into the trading day, and markets are rallying hard. S&P 500 well above the 6,400 level. NASDAQ adding almost 200 points.
Looks like a new record.
Yeah, it'll be a new intraday record, a new closing record if we hang here. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Coming up, we're going to talk about Microsoft joining the $4 trillion club as Meta seizes its AI moment. Apple lower this morning, and Amazon take the spotlight next after the bell, Matt.
President Trump unleashed a series of tariff deals and demands ahead of his tariff deadline. That's tomorrow, for those keeping track, including surprises on India, copper, and cheap Chinese goods.
And the president also renewing his feud with the Fed chair as a deluge of data continues.
A deluge of data.
Deluge?
I don't know. I just like to say that also.
A lot of data.
Sonali, what a day we had yesterday. Before you got all the earnings out, before you got the copper announcement, Jay Powell shrugging off pressure from the White House, rejecting arguments for a rate cut from two dissenting officials, even saying it's better that they didn't hike into this increase in inflation.
Despite elevated uncertainty, the economy is in a solid position. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen.
The chairman went on to say, you could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation. That's what I was talking about. Let's bring in Rich Clarida, PIMCO Global Economic Advisor. He is also a former vice chair of the Fed. It's great to have you here. I'm so glad.
I'm looking forward to it.
Normally we lose you to surveillance, you know, so we're happy.
But we stole you back.
We're happy you
We're
stay a
running
little
that
bit later.
wrong, yes.
What do you think about? I mean, we got stronger inflation numbers today, and the jobs market, as Jay Powell said, still looks pretty solid.
Yeah.
So why should they be cutting?
Well, obviously, there's a range of views on the committee. You had Governor Waller and Vice Chair Bowman registering a preference for a rate cut. You know, the chair himself a couple of months ago actually said that, but for the tariff uncertainty, they probably would be cutting rates. You know, the other thing about the labor market is we have a low unemployment rate. That's good. But if you open up the data, beneath the surface, the labor market is softening. And in particular, participation in the labor market is still a little bit below prior peak. So I think there's room to run in the labor market as well.
But how much would it have to soften to offset any inflationary pressures that we're seeing? You had the Fed chair also saying he's already looking through that goods inflation. And so realistically, what does that unemployment rate have to be?
It's in the eye of the beholder, but I think they've been clear from Powell on down that if they see a softening in the labor market, and I'll define that in a moment, that they will cut even regardless of the tariff impact on prices. My own sense is certainly if we were to get a negative payroll growth, so payroll contraction, that would be sufficient. Private payrolls are definitely running under 100,000 now in many months. Secondly, I think if we get a rise in the unemployment rate, I'd say above 4.5% from 4.1, that would probably do it. I'm not predicting that, but if we saw that softening, I think that they would be cutting.
We saw, if you look at GDP, right, in the first quarter, we were importing a ton of stuff because we wanted to get ahead of these tariffs. We didn't see that in the last quarter, which is why we had a much stronger number. But that inventory is almost gone now. I know from the car world, which I follow very closely, we're finally starting to run out of pre-tariff cars on dealership lots. So you'll see, those prices, I guess, have to go up, or
you're already seeing it.
Or are manufacturers able to push some of that onto suppliers, eat a lot of it into margins, and hold off on giving too much to consumers?
Well, that's the big question. What is that split between the final consumer, the margin of the importer, and the price charged by the exporter? Those are all in play right now. I think there's a lot of uncertainty about how that is going to be split up. What we can say, Matt, is up until this point, not too much of it has actually been passed through to the final consumer. I think some of it has been eaten in margins, and you all do the earnings call here at Bloomberg, but I think a lot of the earnings call are talking about the effect of tariffs. So there is an earnings effect. I think that's why the Powell Fed says it wants at least 2 more months of data before it begins to have a conversation about rate cuts to get a sense of how much of that is passing through to the consumer.
Now, you alluded a little earlier to the dissents, and while it's really tempting to ask you about Fed independence, I have an adjacent question here about politicization, because the 2 people who dissented were Trump appointees. One is reportedly in the running for that next Fed chair job. What does it say for them to dissent at this particular time? Do they look politicized, frankly? And does that have broader ramifications for the type of pressure the president is putting on the Fed?
Well, I hope not, because I think both Governor Waller and Vice Chair Bowman have made a case and will make a case that given the data now and their view that the tariffs will not be inflationary but will just move up the price level, I think there is a case to cut rates, and I hope their arguments are respected. Now, we're in a very polarized political world, so there will be those charges, but there certainly is a case to be thinking about or cutting rates right here.
Well, I mean, following on that question, something Sonali and I have been talking about for a while is if the Fed cuts, especially if it's like a Kevin who comes in and drives cuts, does that really have the effect of pulling the 10-year yield down? Because doesn't the bond market see through, like, Kevin Warsh was an inflation hawk, and now all of a sudden he wants to see cuts, maybe because he serves at the pleasure of the president?
Is there a higher term premium on the 10-year because of that question?
Thank you. Thank
well,
you.
Okay, so the short answer is whoever becomes the next Fed chair will be under a lot of scrutiny. And the question is, what are the conditions at the time that this person becomes Fed chair? It could well be the case that they will justify a cut. The Fed's own models say a neutral funds rate is 3%, not 4.5%. And so it may be a straightforward case to cut rates given the economy calls for it. It is more challenging if a person comes in and is cutting rates in a different environment. And there, indeed, the bond market, and I've written about this before, markets are going to have a say and basically be assessing the credibility of the Fed. In particular, rate cuts that trigger increases in bond yields and higher expected inflation is not what central bankers want to see.
Can I just...
please.
Can I just quantify or add on to my question? The president wants 300 basis points of cuts. So how does the market react if a yes man at the Fed convinces somehow the FOMC to do that and we go down to 1.5?
Well, there are a couple might be below the neutral rate, well below.
So a couple things here. One, even though we tend to talk about the Powell Fed or the Greenspan Fed, whatever, monetary policy decisions are made by a committee. And so the chair only has 1 vote. And so you would need 7 of the 12 members on that committee, or 6 plus the chair, to try to cut rates by 300 basis points. Most economists would say right now, and I would be in that camp, that where the economy is today, a neutral rate is around 3%. So 300 basis points down to 1 is typically what you'd only see in a pretty deep recession.
All right.
And nobody wants to be in a deep
No, we don't.
We could go forever here.
Yeah, we want to keep you for the hour.
Okay.
Rich,
very uncertain environment out there. That is PIMCO Global Economic Advisor Rich Clarida, just on the heels of Fed Day. We thank you so very much for joining us here on set. And it's been a busy week for Mag 7 earnings as well. Earnings are rolling in and investors are liking it. Microsoft and Meta wowing Wall Street as we wait Apple and Amazon after the bell today. I think the price movement is pretty interesting. Alphabet's still lower. Joining us now with more, Bloomberg Tech co-host Caroline Hyde. Microsoft, $4 trillion in market value here. Ultimately, what is going to drive their valuation moving forward? We know that they could spend more money, but how is it going to be paying off?
Well, if they can keep that cloud growth coming, Sonali, it's a winning formula. 39% growth in Azure. They actually broke it out for the first time, a $75 billion amount raised by that cloud unit in their fiscal full year. So finally, we're seeing that this bang for the buck in capital expenditure is really paying off for Microsoft. And they're going to keep on spending. They're saying that they're going to be spending $30 billion in the next quarter, ramping up for the rest of 2025, because they want to galvanize that growth by having the compute, the infrastructure there to satiate the cloud demand. At the moment, demand outstrips supply. That's what you heard from Alphabet as well, and why they increased capital expenditure. And then you have to turn your attention to what Meta is doing, which also saw, when you see Microsoft post posting, what was it, in excess of 18% growth in terms of their full year revenue and 39% on the cloud. You've got Meta putting in 22% increase in revenue and also increasing its capital expenditure. No wonder these companies are shooting up higher in terms of shareholder value. And I think Microsoft just inching in, and we hit 4 trillion, we're just slightly sub it. We'll see if we can close at that level.
Caroline, I want to ask you about Figma. This is a company that a lot of people are being introduced to today through, I think it's the biggest IPO of the year, right? Raising well over $1 billion, pricing above the range. What is, the left coast expecting out of this company?
Well, they've got to keep up with AI innovation, and that's why the $1.2 billion is being raised. They want to completely focus on more product. This is a company that is throwing out products on a regular basis. They've just added 4 more in 2025, one of them being Figma Make, which is a generative AI offering around the design of software, of applications. There is a party atmosphere down here at the New York Stock Exchange. They've got a live DJ at the moment because really you're seeing everyone come together and celebrate what is the biggest VC-backed IPO since 2021, since Rivian. And then $1.2 billion is a lot, is this the most significant amount raised in an IPO by VC-backed companies since 2021 as well. So we're seeing a company that managed to price above the range at that $33 level. They're inching in on that $20 billion valuation that they were going to be paid by Adobe, remember, when they were trying to buy the business. That fell away, regulatory hurdles. They managed to get that $1 billion payday from Adobe, and now they get a big payday for some of the biggest venture funds out there. Just think Index Ventures is going to be joining me in a moment, Danny Reimer. And look, they put in a Series A their overall valuation. Now they're sitting on about a $2 billion win here. So are the likes of Kleiner Perkins, who we're speaking to later in the show. And of course, importantly, we're sitting down with Dylan Field himself, the CEO of the business. What a journey in the last 13 years, having built this company, and he still controls more than 70% of the voting shares. How is he going to manage as a publicly traded company that wants to invest? And he says, look, very candidly in his S1, I'm going to invest. And I'm not always going to be thinking about your profitability, but I am going to be thinking about revenue growth and about generative AI and how that disruption is going to be owned by my company.
All right, Caroline, thanks very much. Caroline Hyde there from the New York Stock Exchange, where Figma started trading, or will start trading, I should say, probably within the hour. The next hour or two?
Usually it takes a couple hours. Yep. This one was a big one, but interesting. If they go public, if they pop, they might be above the valuation that Adobe tried to buy them for. So if they hit that, they're feeling pretty good about staying independent. I also like that you called it the left coast because we are the right coast, right?
Yeah, I like that, Sonali. That's a fighting spirit.
Well, there's somebody coming from the left coast next.
I mean, only on the West Coast could you value a browser-based collaborative vector graphics editor at this level. As Caroline mentioned, she will be back later this hour for an interview. The CEO of that vector graphics editor, Danny Reimer of Index Ventures, an early backer of Figma. That's ahead of her interview with Figma's CEO at 11 a.m. New York time, an interview you don't want to miss.
And coming up, the left coast coming back to the right coast. Robinhood reporting a solid quarter as it pushes beyond retail trading. We're going to bring in CEO Vlad Tenev joining us here on set next. This is Bloomberg Open Interest. Welcome now our Bloomberg radio and television audiences. Robinhood is posting second quarter revenue that beat Wall Street estimates, boosted by strength in cryptocurrency trading. We're joined now by Robinhood Chairman and CEO Vlad Tenev, and you're back up on the day. You're bringing your year-to-date gains for Robinhood closer and closer to 200%. Your stock has just soared this year. Do you feel pressure at that valuation now to increase your growth rate to meet investor expectations?
I think we're always challenging ourselves to serve our customers better and consequently grow the business. But if you're asking if I'm like looking at the stock and trying to drive that directly, no. I mean, we're looking at the inputs to our business. And right now what we're seeing is our customers are happy. Net promoter scores are at a 4-year high. It's leading to net deposits, which have been very strong through July. And that's leading to gains in market share across all of the assets. And you're seeing that in revenue and EPS, which have been very, very strong as well. And we're having these product events where we're announcing products that are, I think, far ahead of where the rest of the industry is. So I don't think it's slowing down. We're, if anything, accelerating further.
By the way, more than 420% over the past 12 months. You're worth almost $100 billion. You're now worth a lot more than Intel, which for an old guy like me, that's a real milestone. Where do you see the biggest growth? I know you're expanding overseas. We talked with you last time about tokenization. What's the biggest shooting star at Robinhood?
I think if you look long term, the big potential that I see for Robinhood is how can we expand across two different axes. One is from being US only or US primary to being fully global, available to billions of people around the world. And the other is, can we go from being retail only and serving the full wallet of a retail customer and being this sort of like financial super app to a full platform that serves not just retail, but businesses and institutions. And we're getting into that through some of the acquisitions that we're making and through organic platform expansion.
By the way, could I live on Robinhood now? I mean, could I have Bloomberg deposit my paycheck with you and pay all my bills with you and, get a loan from you and do my trading with you? Are you looking at that full suite?
And how fast can you get there?
You can do the lion's share of that. Robinhood Banking is actually rolling out later this quarter. We're still on track for that. It's now rolled out internally to our thousands of employees, and it's looking really good. So that'll allow you to put in your paycheck, get checking and savings accounts. You don't have to go to the ATM. We figured out how to get cash to you, to where you are. For those of us that still use cash, you can do your estate planning. We have a home loans partnership with Sage that lets you have a mortgage at an industry-leading rate. And of course, your trading, your investing, your advisory. So we can help you with the lion's share of that. I didn't even mention the credit card, but you saw my credit card last time. I think it's the best credit card on the market.
So you were talking about Robinhood Banking launching to a broader audience soon, but what does that put you in terms of your relationship to the broader banking industry? You just saw about a day ago JP Morgan and Coinbase inking a deal to allow wallets to be more linked to bank accounts. Are you going to be partnering with banks, or are you running in direct competition to them?
I think that as our companies become bigger and bigger and just diversify into more segments, the relationship with counterparties will be collaborative and will partner in some ways. And of course, in the broad sense, every financial company competes with every other one if your goal is to get customer assets and greater wallet share. But I think it's nothing in the financial services industry. The large companies have always collaborated and competed across different axes.
So to Matt's point a little earlier, one, you're growing tremendously. You have stock as currency to do so. You became worth more than Intel. How much firepower does that give you for a transformative acquisition? Could you do something much bigger? And what are the types of places you would look?
Yeah, interesting. I've never had Intel brought up as a comp. But I see what you mean about that being historically, these companies that you think of as very infrastructural.
It's iconic. It's an iconic company. If you grew up with it like me, and then you've eclipsed it.
Even being in the same conversation as those brands is humbling. I think we've always been very deliberate with acquisitions. So we want to make sure it pencils and it makes sense for the company. It gives us 18-month acceleration to the product roadmap. We get a team that's DNA culture aligned with us because we like to move fast and we have very, very high bar for talent. And if all those are met, we've been pretty active, as I'm sure you're aware, in the acquisition market. So I wouldn't say I have a particular itch, but we've got a great corp dev team and we tend to look at every opportunity that comes up.
You became a household name during the first wave of retail trading, post-pandemic retail trading, and now we've seen that pick up again. In fact, a lot of investors or bankers come on this show and say it's really retail that's bought this 30% surge from the bottom in April, and institutional investors have to catch up. Can that hold? Have we seen a fundamental shift in the way people invest?
I think the fundamental shift is that if you think about, institutional investing, all these fund managers, it's very abstracted. So I think they tend to make decisions about portfolio allocation based on macro factors. Tariffs, geopolitical conflict. Let me use that to rebalance the portfolio. And so you end up having somewhat strange things where a company that is unaffected or perhaps benefits from that type of uncertainty could just get sold off because of broader macro. Now, retail doesn't think that way. Retail says, I want to buy this stock because I believe in this particular company. And so you see them doing very, very well in this scenarios where, broad market activity affects companies that are otherwise doing very, very well and shouldn't be unaffected, but institutions' hands are basically forced because they have to reallocate. And I think that's it's a positive thing. We've gotten so abstracted that I think we need to get back to the basics of people buying stocks because they believe in that particular company and not because of some sectoral correlation that may or may not actually exist.
Well, it's great to get some time with you, Vlad, especially here in New York on set with us. Vlad Tenev there, the CEO of Robinhood. This is
Thanks for having me.
Nice.
Didn't get to make my right coast joke. Got to check on these markets. We are still in the green for the S&P 500, well above that 6,400 level, up about 0.7%. NASDAQ 100, so too, gaining from those Microsoft Meta earnings last night, just blowing through expectations. And the 10-year yield, you're looking at it hanging out around 4.34. Coming up next, we're going to talk to Norwegian Cruse. Stick with us. This is Bloomberg.
It is smooth sailing for Norwegian this morning. The shares up 11%. The cruise line says demand rallied in recent months, allowing it to confirm guidance as it overcame early jitters in the beginning of the quarter. Joining us now to talk about this is CEO Harry Sommer. And Harry, just tell us about the kind of demand that you're seeing. Is it a bounce back from consumer concerns about tariffs as those dissipate?
Thanks for having me on, and good morning, everyone. Listen, our demand for the last 3 months, May, June, July, was a record for the company. We're thrilled that the consumer's back. I mean, let's face it, April had some macroeconomic headwinds, due to some of the uncertainties in the environment around tariffs, but glad to see that the consumer is alive and well, that they like to cruise, and they like to cruise on our product.
Even if the consumer is alive and well, do you see people holding back anywhere? And if you do, what do you think could change that? Is there pent-up demand to be spending on cruises that are not being seen right now?
I'll say that the recovery in demand that we've seen over this last 3 months has been pretty much across our entire product line. We see it on our premium line, Norwegian, our luxury line, Oceania, and our ultra luxury line, Region 7 Cruises. All three are getting top-notch bookings, well accelerated over where they were on January through April on a relative basis, and really across all geographies as well. We've shifted our itineraries a little bit to focus more on shorter and closer to home itineraries. I think that's helped as well, but we've really seen the demand everywhere.
What do you see in terms of costs, Harry? I imagine personnel is your biggest cost. Fuel costs must have come down somewhat in this quarter. How's that working out?
So, we set up a transformation office a couple of years ago when I took over as CEO with a focus on purchasing things more efficiently, getting better economies of scale, things along those lines. And we're really beginning to see the fruits of that as well. So while, inflation continues, in the 2 to 3% range, depending on what gauge you use, we are having flat costs. So we reported flat costs for the quarter. We're going to have flat year-over-year costs for Q3, for Q4, for the entire year. We are laser focused on doing things more efficiently. But I just want to reiterate, it is never at the expense of product. We 100% decline any cost reductions that will impact the guests. And as a result, we have record guest satisfaction scores, record guest repeat rates, record onboard cruise sales. We are thrilled with the onboard product delivery.
I do want to press a little more on costs here because I can't imagine how many lobsters you're buying in a year or bananas. And do you worry? People are looking into 2026. The inflation expectations, as you see in terms of swaps pricing, indicates people think prices are going to go higher. Are you worried about that at all heading into next year?
Not really. We have a fantastic purchasing team. We source our products worldwide in the most efficient way possible. We are committed to continue to buying things efficiently and effectively and continue to look for costs that don't impact the guest product. And I'm confident that we can repeat this again in 2026, a below inflationary cost growth year over year.
I wonder, when I think about the effect of tariffs, duty-free pops into my head, and I know you guys offer that, at least on some of your voyages. How much revenue does that make up? Because I'd imagine that people on cruises are also apt to want to buy cigars, booze, watches. Sure. How much of that is a moneymaker for you?
Sure. So, absolutely, we have onboard shops, especially in our bigger Norwegian cruise line ships where we're carrying, 3,000 to 4,000 guests. It's popular, especially on the close to home cruises where they can easily take the stuff that they buy back home. We do very well with liquor. We do very well with jewelry. Those are absolutely popular. And of course, we are not subject to tariffs because we transit in international waters. So we don't have the impact on the cost side, but we do get the benefit on the shipboard sales side.
To the extent that you could see yourself beating expectations through the rest of the year, right? Obviously, investors are reacting really strongly to the jump back that you've been seeing. But ultimately, what could help you really jump back in a bigger way through the end of the year? Is there anything that's still holding you back today that won't be 3-4 months from now?
We are never done looking to improve things at the company. We have a relentless pursuit to drive both the top line and the cost section of the P&L, but specific to the revenue side of it, we have ambitious efforts around brands at all three of our companies, Norwegian, Oceania, and Region, to continue to refocus the brand on what guests find to be most interesting and exciting for them. We have great brand work being done across the three brands to do that. I think our recent announcement of our private island, Great Stirrup Cay, which we announced earlier this week, has been just one manifestation about that, providing guests what they want and what excites them to come on board. So I think as we continue to improve our own branding and our own storytelling in the public and continue to improve our onboard product and shoreside products, I think that has a possibility to continue to accelerate demands at the levels we're seeing them now.
Harry, we thank you so much for joining us here today. Harry Sommer of Norwegian Cruise Lines, and the stock is up pretty significantly. It was up the most we've seen since April 9th, kind of the market low there that day that President Trump, I believe, said to be buying stocks, reversing some of that earlier hit from Liberation Day tariffs. And you look at us now, and Matt, we are above 6,400 on the S&P 500.
Yeah, that's right. We're looking at big gains. Not as big as we saw at the open, and the question is, do you see some of those dissipate into the close? But right now, the S&P at 6404 and the 10-year at 435. Let's get a look at some of the single stocks moving at this hour. Microsoft entering the $4 trillion club. We'll see if it holds there. Actually, I don't know if you saw this, Katie, but Assad and Katie have a bet. She thinks it's going to dissipate throughout the day and under that. And
under 4 trillion.
Assad thinks it's going to hold over 4 trillion. Right now, 3.983
is what I want to know. What are we betting? I'll bet chocolate bars.
All right, I have a chocolate bar at my desk.
Okay, good. I'll take that from you later. Anyways, it's really interesting. Meta is at a record now, and you have to wonder who the winners and losers are going to be. Amazon is rising in synchrony, but Apple is really not feeling the love, and you can hear investors putting the pressure on. It's about flat now, and the trade, you're actually flipping into the green a little bit, but it was lower in the day, so shaky investors heading into those results, Matt.
Yeah, absolutely. Those four of the Mag 7. Another one we're watching is NVIDIA. Chinese authorities summoned the chip maker to discuss alleged security risks related to the H2O chips. So there's a mover, but actually to the upside. So that's apparently not bad. Carvana reported record quarterly car sales, and the CEO saying there is room to run 20%.
I looked this up for you this morning because I am just blown away. Yes, they had record sales. The stock is at a record high. They're actually moving up in kind of car class, if you will. More expensive cars are being sold, so of course they're being making more money for them. But what does that mean for the broader used car market?
Right. Well, I think a lot more people are looking at used cars as the price of new cars continues to rise higher. And then, can you get a car on Etsy? That's like stuff you make at home, right?
Get a whole lot of wedding stuff on Etsy, though.
To your friend. Do you do that?
Oh yes.
They make like a veil, or they make like a garter?
For ideas and stuff like that. I'm not going to talk to you about my garters.
Well, maybe we can talk about a fig when we come back. Figma is one of the most highly anticipated IPOs of the year. We heard it's the biggest venture capital-backed IPO since 2021. We're going to talk about the debut with one of its largest shareholders, Danny Reimer, partner at Index Ventures. Next, this is Open Interest. Figma shares set to begin trading after the company and its backers raised $1.2 billion in an IPO. Let's get to the New York Stock Exchange, where Bloomberg Tech co-host Caroline Hyde is joined by a very early backer of the company. Caroline?
Very early. I'm joined by Danny Reimer of Index Ventures, who basically was one of the first checks in. You met Dylan Field, the CEO of Figma, back when he was, 18 years old? You backed him when he was 19 years old. How does it feel now to see that it's almost worth $20 billion and gone and IPO'd at the NYSE?
Yeah, it feels really, in a lot of ways, surreal. But I must say that he felt like a very unique person when I met him for the first time. I recollect him as an intern when I met him at Flipboard very vividly. So there was something special with him throughout.
And he had a vision about design, about making it more easy to interact, to work together. But that vision has to keep on scaling with this current moment of generative AI. Does he have the bandwidth to do that as a public company?
I really think so. I mean, I think that what he's done so well is hire a phenomenal team. They are called Figmates, and they're in many different places, and they're so passionate about how important design is in our world that I think that the pace of innovation is probably going to accelerate like you saw it accelerating in 2025.
And actually, he was very candid. Dylan was very candid in his S1, saying, look, I want to be efficient, but I'm going to invest in this company.
Yes.
How much do they need to invest? How much are you seeing the startup community in generative AI nipping at their heels, or are they streets ahead?
I would say that obviously you're going to always have innovation, and design is so critical that you're going to not only have established players, but new players on the scene. And I think that, there's no question that Dylan's going to be uncompromising in terms of doing the best thing for building Figma into the biggest company that it can be.
He's able to be uncompromising because he has majority control in terms of voting shares. What's your view on how Index now follows them as a public company? Because you obviously had a liquidity event, needed it for LPs and for the future of your business, but how long do you remain a committed investor?
Yeah, I mean, it's such a privilege to be part of it, and we have so many great hopes for this company. Every year, I've gone back to the partnership, and we've discussed it as a partnership, saying there are opportunities actually getting larger. So, we do not have much pressure to provide liquidity events as long as things are going well.
Can you talk to us about that growth opportunity? Because they're already incredibly international. I think like 80% of their monthly active users are outside of the United States. But where are the growth opportunities? They've got Figma Make, which of course is the generative AI product. They've got ways in which you make your product go onto websites very easily, or indeed onto social media. But where else do they pull?
I mean, I think if we can see these 4 new products launch and get the type of adoption that design and dev mode and FigJam and Slides has gotten, we'll be in a really happy place, because Figma Make is really important for the future side of how AI gets integrated in the whole design process.
Okay, there's a party feel here today. They've got DJs, we've got all of the employees and those that have backed them for a long time. Is there a party feel for others in your portfolio companies that want to go public if this does well?
I mean, of course. Of course.
Does it open the doors? Are we seeing an unlocking finally of the IPO market?
I've always thought that, back to my equity analyst days, I've always thought that great companies can go public in any market. So I think that the reality is Figma could have gone public in any market. Of course, seeing the appetite that there is from the buy side and from investors as a whole is a really good sign for what's up ahead. And yeah, we have, Service Titan went public earlier this year. We have some great companies in our portfolio. I'm really excited about the year ahead.
You got Discord, for example. What's interesting, though, about Figma is that they managed to IPO at a valuation double of what it was in 2021. A lot of other companies can't be able to say that. How much was that idiosyncratic to Figma and the way that it's grown, or how much are you able to replicate that in some of the other portfolio companies?
I mean, it's a great point. I think it's going to be adverse selection, right? The companies that are going to be able to go public are primarily going to be great companies who you're probably going to see an appreciation in their valuation.
Well, 40 times oversubscribed. We wait for the opening trade, but they managed to just almost be at that $20 billion level that Adobe once tried to buy them for. Danny, congratulations.
Thank you very much, and thanks for having me.
Danny Reimer of Index Ventures. I mean, really, backing him at the age of 19, he really saw something in Dylan very early on, Sonali.
Caroline, we thank you so much for that interview. Thank you to Danny Reimer of Index Ventures and Caroline Hyde. And don't miss Caroline's interview with Figma CEO Dylan Field next hour on Bloomberg Tech. As she had mentioned, this is an IPO 40 times oversubscribed, pricing above its marketed range, raising $1.2 billion, just a massive listing, and it could become over that $20 billion in valuation that Adobe tried to buy it for years ago. Anyways, elsewhere on Wall Street, we're talking about more money being made, and this time in the hedge fund world. Chris Rokos is hiking fees for clients of his hedge fund. Rokos Capital Management is asking investors to agree to a gradual increase in fixed management fees to 2.75% over the next 3 years. For more, we were joined by Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. And, Matt made this good point in the commercial break earlier. This is getting closer to 3 and 30, which is a number you see among big multi-strat hedge funds, perhaps.
They're going to take 25% now of profits, so.
If you're counting pass-through fees, though, if you're not, then this is what you have to do, isn't it?
And that's the dynamic here, right? For the last few years, we've been talking about this diversion in the hedge fund industry. We talk about the multi-strat hedge funds and the others. Now, the only people who can compete with the Millenniums and the Citadels of the world are some of the biggest hedge funds. And if you're one of the biggest hedge funds in the world and you've had good performance, like Rokos has had, if you look at the last 3 years, that's 31%, 9%, 50%, already up 12% through the first half of the year. This is the time where you get to tell your investors, maybe you should be paying me more in management fees so that I can invest in getting the best talent, because you are getting sick and tired of seeing the Citadels and the Millenniums offer these crazy packages to all the top talent there, and you will be left on the losing end of the bargain. So that's a reason they're throwing out to investors as to why they have to increase the fees here.
Did you say 50%?
50% performance, not fees.
50% performance is fantastic. That's like almost
2022 was a good year.
Levels. How much are they having to pay for compute, for AI? Because we were talking with Reflexivity last week, and they were saying, like, pretty soon junior analysts are going to be replaced by this technology.
Look, as part of their stated reasons, they do say they have to invest in top talent, and they also want to invest in research and technology. So that makes sense. But I will also point to the reason, and this is perhaps not something you would advertise to your investors, but it is worth remembering that Rokos is about $22 billion in size. And for a hedge fund to continue to perform well and to continue to bring in the big returns, there also has to be an element of flexibility in the ability to stay nimble. And that's hard to do when you grow too big. That could also be a reason to test the waters and see if there are investors who are willing to accept the higher fees, and if there are any redemptions, they may be willing to take that.
Could be tougher. I guess you could be paying 3 and 30. You're still less than that for a macro fund that was up 31% just last year and another 12% this year. Sri, thank you so very much for joining us. That was Sridhar Natarajan, Bloomberg's chief Wall Street correspondent.
On what was one of the most read stories of the day. I mean, Bloomberg clients really care about this story, and it's just directionally, it's just heading higher and higher.
You know, this is a macro trading firm, and for the last 3 years that's been the trade. There's nothing showing that that's going to stop, given the way different asset classes are moving. But frankly, it's really interesting. These guys are having their time in the sun again after what was years of hedge fund performance being questioned, passive taking over. Why not buy the S&P 500 and let it be? And now people are looking for diversification.
And I mean, we didn't even talk about pass-through fees, which is insane, right?
Yeah, totally insane.
That's the cost of doing business, and you're going to add that on. All right, we'll continue this, obviously, discussion with Sonali Basak. There's no way around it with her. Coming up, Friday's jobs report will likely show hiring cooled. We'll have a preview of the NFP number next. This is Bloomberg.
And tomorrow we're going to get the latest read on the labor market. The July data is forecasted to show further softening in hiring. And we're going to get a preview now from Bloomberg's Michael McKee, Bloomberg International Economics and Policy Correspondent. When you look at the totality of the information we got this week, the idea that inflation could still be a concern here, how much does the labor market actually have to weaken to show bigger concerns from the Federal Reserve?
Well, it's an interesting question because the Fed has emphasized labor market weakness as a possible sign that they need to cut interest rates. It's their view of the overall economy's outlook. And Chris Waller, in his dissent, made a big deal out of that, saying that the labor market is showing signs of cracks because he's looking at the overall hiring numbers. But today we got the jobless claims numbers that were still very, very contained. Doesn't look like there's any kind of mass firing. So it's probably not so much that unemployment goes up. It's forecast to tick up by a basis point tomorrow to 4.2%, but how fast they go up. If you got up to 4.5%, say, by September, then they would be worried because it would suggest that companies are starting to ramp up their desire to get rid of people, and they might want to get in front of that. But if it's just a tenth here, a tenth there, not a big deal yet.
So we're looking for 104,000 jobs added. When does the Fed start to get worried? When do those numbers start to merit a cut?
Well, it depends on whether you're at the Fed or on Wall Street. You get below 100,000 and Wall Street's going to start to get worried. But the Fed is looking at the total number of jobs created that would fill the gap of people coming into the labor force. And so it's considered somewhere between 80 and 100,000, and they wouldn't be particularly worried. We're clearly seeing a slowdown, but we're seeing a slowdown in hiring. We're not seeing a speed up in firing yet, and that's what they're keeping an eye on.
We only really have less than 30 seconds left here, but wages and salaries barely rose. With that under consideration, then doesn't this inflation hurt a little more?
Well, it would, yes. Wages and salaries didn't really rise in the PCE, but in the employment cost index, which was also out today, they were up 1%, fairly strong. So you got to figure out which one you want to look at in this case. And the Fed generally looks at ECI.
Mike, we thank you so very much for joining us. We're looking forward to your readout tomorrow as well. That is Michael McKee back with us for Jobs Day.
The granddaddy of all economic statistics, 8:30 a.m. Tomorrow morning. He's going to bring us, by the way, an interview with Cleveland Fed President Beth Hammack.
Ask her about the basis trade.
We're also, oh my God, the basis trade. We're also going to speak with BlackRock's Rick Reeder. Plus, we'll talk tech with analyst Craig Moffett at MoffettNathanson. So it's going to be a jam-packed show. This is Open Interest.